This episode of the Media Leader podcast was edited by our production partner, Trisonic, a results-focused agency that plans and buys all audio media. Check them out at trisonic.co.uk. That's trisonic.co.uk.
I'm a fan of in-housing where in-housing makes sense. I'm a fan of utilizing artificial intelligence where it makes sense for certain automation. Where it doesn't is where it's trying to replace the high-level strategic thinking, creative and innovative thinking that agencies have always built themselves on.
Welcome to the Media Leader podcast. I'm Jack Benjamin. It's not often you hear of a media agency going out and acquiring a venture capital fund. But in February, indie agency MNC acquired Grwth, a VC fund with a focus on investing in consumer brands. Luke Bristow, who has worked as MNC's CEO for nearly a year, told me at the time of acquisition that the model gives MNC skin in the game with clients. It's a great way for us to not only have an exciting external-facing proposition, but actually for us to put our money where our mouth is, he said at the time. I wanted to catch up with Bristow a few months after the acquisition to see how it has changed things for MNC and the way it approaches clients. We also spoke about the rapidly changing media landscape, where indies see opportunities for disruption, and what the state of play among the holding groups means for advertisers. This is that conversation. I hope you enjoy. Luke Bristow, welcome to the show.
Thank you, Jack. Yeah, pleasure to be here.
So you've been CEO of MNC for about a year now.
Yes.
What attracted you to the indie in the first place? And also what attracted you to media more generally as a career when you're first starting out?
Good question. So I have been in the independent agency world for best part of a decade now, after leaving Ogilvy and started out my career in kind of like that WPP fold. So the indie agency space wasn't new to me at all. And kind of going back to my early years, I fell in love with media and advertising straight out of university. I studied psychology and specialized in persuasive communication. So I think I always knew I was going to go into something like this, whether it was media, advertising, PR, marketing generally. It kind of felt like my calling, and, cut my teeth in, like I said, one of the holdcos, and was brought up very much in the generation of those employees at some of the big agencies that were the first kind of social natives coming through. So it was quite an interesting time where historically at the big ad agencies, the more time you spent there, the more experienced you got, and therefore kind of the more senior you were and the more responsibility you got. However, when the wave of kind of social media came in, and that was going back to kind of 2012, 2013 now. So this would have been Twitter and Instagram and probably Facebook were the kind of the main players. But the kind of the more senior execs at the business didn't have the hands-on experience with these channels in the way that they would have with more traditional channels. So actually the wave or cohort of kind of new talent coming into the Ogilvies of this world were rolled out into, pitches that they probably had no right to be in and probably didn't really have the experience or merit to be in. But because we were so indoctrinated with some of the channels that we were needing to speak to and advising clients and brands on, it was a great way to, like I said, cut our teeth and get thrown into the deep end of, like I said, pitches or senior client meetings or being wheeled out into areas like that. So I've got a lot of fond memories of coming through the ranks there. But I definitely did fall out of love with the corporate advertising world after 3 or 4 years. I think there was, I've always had a bit of an entrepreneurial itch, and that needed scratching to some degree. And it's obviously quite hard, as much as kind of, the larger corporates try to kind of embody agility and entrepreneurialism within their organizations, and some do better jobs than others. It is hard to kind of feel like you are making the impact and having the purpose attached to whether it's your client work or whether it's kind of your personal progression in larger organizations. So, like I said, fell out of love with that a little bit. And then
was that entirely falling out of love for personal reasons, for that entrepreneurial spirit, or were there other things that caused you to reconsider?
Yeah, I think primarily, I can't everyone that I worked with in those organizations were excellent, and it did, big names like Ogilvy really attracted good talent. So there was I loved kind of waking up and being able to work with smart people that had the energy, had kind of shared life experiences to me and were able to kind of stimulate and challenge me intellectually. But I just felt that being part of an organization where at the end of the day you are a number on a spreadsheet, or a line in an Excel, if you like, it's hard to dictate your own terms and control your own future in the way that I think I wanted to do. And not saying by any means that I had reached a ceiling, because I'm sure there's lots of things that I could have gone on to learn there, worked with bigger brands, more international, etc. But I felt that by moving into an India, the age of probably 26, 27 was definitely the right call for me. It allowed me to get a lot of exposure to things like working at the senior level of a business where you're looking after the P&L of an organization, or the international expansion of an agency, and things like that, as well as HR and the marketing of a business, and how and why clients kind of choose to work with different agencies. So yeah, like the indie agency scene really appealed to me, and it kind of helped me fall back in love with what drew me to advertising and marketing in the first place. And then I kind of I was with two different organizations, one called the Honey Partnership, which was a social first creative agency set up by some of the founders of Next 15 Group. So I was one of the kind of founding members there, and was there for a couple of years, and it was a great kind of exposure to how to launch an office in Amsterdam, for instance, and how to kind of grow clients from kind of into different offices, and how to build a team from 5 to 50 people, and all the kind of stuff that comes with that kind of startup, in the trenches together feeling. And then the 5 years post that was at an organization called NewGen, formerly Kairos, which was, in short, an influencer marketing agency when I first joined. And it was right at the precipice of when influencer marketing wasn't even called influencer marketing. It was probably vlogging, I think clients used to come to us to ask for,
right,
or YouTube marketing perhaps. And so we were right there in the early days of clients understanding that. It was very immature, it was very Wild West, but again had a huge ceiling, and it was a huge opportunity for me personally and professionally to get exposure to a really fast growing area of the industry, and still kind of maintain a really strong relationship with some big high profile brands. So have had the pleasure of working with lots of the Fortune 500 companies over my kind of years in various different capacities. But yeah, we kind of rode that wave, and I got a lot out of that, and I think the business and our clients did very well out of it as well, having individuals who really lived and breathed the channel, if you like. We were a specialist agency that were right on the pulse of how to work with creators and influencers across the different channels as they were emerging and forming. And yeah, that was an incredible journey for me. We did a number of different acquisitions as part of that, because we were going through gangbusters growth through COVID, which wasn't always the case for lots of businesses, but we were very fortunate.
The opposite from it.
Yeah. So we were very fortunately placed to benefit, again, on a humanitarian kind of and moral kind of questions attached to that. But like from a business point of view, we were very fortunate to benefit from the pandemic, and it meant that we were able to do acquisitions, which again I would have never had exposure to acquiring and integrating 2 or 3 different companies had I stuck it out at kind of one of the larger holdco businesses. And yeah, it's and then timing was right for the MNC opportunity in the summer of last year. With Kairos and NewGen, we did a private equity fundraise with BGF. I had been there 5.5 years. I kind of discussed with the co-founder that it felt like we'd kind of come to the end of my road at the business, it was the right time, I think, for everyone involved. And yeah, MNC had been around for 30 years or so, but had always been kind of proudly independent. So I was really drawn to the fact that they had, entertained and attracted interest from lots of the big advertising and media companies out there, and had never sold out, so to speak. Not saying that, those that sell have sold out, but, had always kind of held on in there and kind of maintained that independence. In 2016 had become an EOT, an employee owned trust. So it's 51% owned by the employees and 49% by the shareholders. So it was a really interesting model that I think appealed to a lot of the values that I had built over the years, but also kind of felt that were kind of core to me from the start. And yeah, the timing was right as well. The founder, Andrew, who had been at the helm since 1997, so had done a long old stint, was kind of reaching a point in his kind of professional and personal life where he wanted to take a step back. So he moved into the chairman's role at the back end of last year, and we've been kind of like transitioning that since. And he's been an incredible mentor and support to me throughout that. You can feel that you got to a point in your career where you think you know everything, and you can always find someone that knows more and can dissect things in different ways for you. So that's been a really valuable and a really close relationship that's been built there. And I kind of was attracted to the business, not just because of its legacy and its track record. It had built a kind of a reputation of working with high growth challenger brands who had huge potential to grow and become household names. So the moonpigs.coms and the confused.coms of this world who, when they first engaged MNC on the start of their kind of 10, 12-year relationship with the business, nobody knew who they were. And by investing kind of in their growth in smart ways, primarily via above the line media, became kind of these kind of very well known, very well loved and respected brands. So I was incredibly attracted to that, and there was clearly a formula and a model that worked. But I was also very attracted by the self-awareness that the business had, that it hadn't evolved and iterated itself and its model with the times as much as it probably needed to. We're still had a very kind of successful kind of core team and really, really great kind of core set of brands and clients on the roster, but had a self-awareness that it needed to change. And also, being kind of totally candid about it, it had a bank balance and balance sheet, if you like, that meant that it was, able to fulfill on the ambitions of change. So to invest in future acquisitions and to invest in diversifying the model, to invest in bringing new services and talents into the business. Because I think you do speak to lots of companies that recognize and have the self-awareness, but unfortunately it's going to be a very kind of slow turning circle in order to be able to achieve that. Whereas this business was the best of both. It was still small and agile.
Had the money, but you were still small.
Had the money.
And you came in, and then just a couple months later, by February, you made your first big acquisition, which
Correct.
was Grwth.
Yes.
Grwth. Grwth.
Yes, that's right.
Which is a VC fund, and it focuses on investing in consumer brands.
Yeah.
And we covered this in February. I don't recall ever seeing another media agency going out and acquiring a VC fund to make that part of the package of the broader business. So take me back to the deliberation. Clearly you had some recent experience in acquisitions. You were brought in to sort of give I don't want to say a facelift to MNC, but certainly push things in a new direction.
Modernize, I think.
Modernize, yeah, it's fair to say. What was attractive to you about a VC fund in general?
Yeah, good question. So, I mean, this wasn't, although it was quite fast, it wasn't a snap decision, so to speak, in terms of coming in and saying, look, those are the guys we want to go for. They are kind of, ready and waiting for us to pull the trigger on. We probably came in, well, I came in, I should say, and I was discussing and deliberating with Andrew and kind of one or two of the leadership team kind of that sat within the MNC business to understand, how do we ensure that we are able to be the go-to or the destination or the one-stop shop for the kind of brands and the profiles that we want to work with? Because we had an incredible track record and success helping ourselves grow and these kind of challenger brands grow with us for many years, 27, 28 years. So the most obvious kind of plug and play acquisition that we could have done would have been to make ourselves completely full funnel within the media proposition. So we already had one of, if not, in my opinion, the best kind of TV and AV planning and buying outfit in the indie space. And that would also encompass other areas of above the line. So out of home, radio and other forms of audio, as well as forms of print as well. So like that kind of like traditional above the line space, we were definitely, if not the best, one of the best in the space for brands of a certain profile to be able to approach and say, how can you help me grow via this kind of medium? I have capped out, or I have reached a max or a plateau on my investment into kind of more performance channels, and I need to kind of start to attract new customers via other means. But obviously in 24 and 25 and beyond, brands have a lot of other options in order to start building their brand and growing their kind of prompted awareness, whether that's upper funnel Meta or YouTube or TikTok. And, all of these channels have matured their advertising capabilities and are continually maturing their advertising capabilities to be able to
programmatic, essentially, just upload your assets, give us what we want to optimize to, and we'll do it ourselves as platforms.
Exactly. And we've got some kind of like house views, if you like, on the effectiveness of certain AI capabilities within those advertising platforms to be able to attract new customers. So
are you suggesting that they're not as good as advertised?
I think so. Meta, as a good example, has a Advantage Shopper Plus, or ASC, if you like, that's used by quite a number of brands from a performance, but also has been utilized to invest in brand growth and brand awareness as well. And we feel that the biggest challenge that it's got is lack of incrementality, to be totally honest. So it's become a bit of a cesspit for incrementality in the last 12 to 18 months probably, but it was all the rage in kind of 22 and 23 to be able to be the answer to investing in kind of the growth of brand. So that's an example of a channel that, don't get me wrong, Meta is still a really, really kind of fantastic channel for growing brand, and a lot of the clients that we work with, we strongly encourage to spend there before they actually break into more kind of traditional mediums in order to kind of test and learn and be able to kind of have control ways of reaching new customers and attract, profitable cohorts of new customers, not just kind of, broad reach and kind of go out to the masses. So there's fantastic ways of doing that. But we have a model now that we apply to particularly high growth challenges that allows them to invest sustainably and kind of go through a much more methodological process of testing and iterating on whether it's Snap or TikTok or YouTube before they engage in kind of those more above the line channels. Obviously, there's lots of things and variables that will impact those recommendations, but we do have a relatively tried and tested model. But yeah, when we kind of taking us back to the acquisition consideration, the most obvious jigsaw piece or plug and play that would have made sense for us was to say, look, we have all of these kind of above the line channels covered, right? Where we don't have is that kind of performance led growth marketing, search, social content kind of capabilities. Let's go out and buy a social search agency and plug them in, and away we'll go. We'll be at the races. And that would make a lot of sense. I think on paper, a kind of a financier would say that looks good, kind of thumbs up, green light on that. And we went to the market and did start a search. We met with a lot of like really exciting, really talented founders and leaders in this space that we've still got really strong relationships with, and absolutely in another world may well have kind of struck a deal with one or two of them.
Could still be a future acquisition.
Could still, who knows? Yeah. We're not writing anything off at this point, and we want to kind of build bridges rather than burn them. But yeah, I think what we kind of always had as a niggle in the back of our minds was that becoming full funnel, and from a media point of view, kind of more paid media full funnel, if you like, not full funnel encompassing everything from PR and UX and other kind of what we would call kind of fringe capabilities for us as a business. But that bringing in like the paid media capabilities to become full funnel only really gets us to par with even where a lot of the other indie agencies, or certainly kind of a lot of the networks are. Right now, there's businesses out there that have strength in certain areas more than others. Some will be more specialist in kind of performance, and some will be more specialist in above the line or brand. But generally speaking, most good future thinking agencies will be able to offer a form of that. So we wanted to accelerate ourselves ahead of that. And when we met Grwth, so we met with Jake Higgins and Joe Ben, who are the two founders of that, and they had a small team. It wasn't kind of, we didn't do this acquisition for headcount or kind of revenues. It was for proposition. And they were two former brand side founders who had gone on to kind of have exits at various different challenger high growth brands, one to AB InBev, which was kind of considered a relative success story in the FMCG space. And they'd formed a business called Grwth, which had a number of different advisory services, essentially, one of which being kind of digital media and helping advise brands on how to grow via investing smartly into Meta and Google and others, to kickstart kind of brands early stage in their growth, talking sometimes less than 5 million annual recurring revenue, all the way up to, 20 to 50.
So a little bit of the performance niche that you were looking to fill.
Exactly, yeah. So like kind of really very hands-on, kind of able to prove the model, minimal valuable products of taking a brand who has a fantastic product but needs to acquire their early adopters and kind of get to kind of a size and scale whereby they want to consider diversifying into other areas. So they had that capability, but what they also had was an incredible network in the space one that I'd never seen before. So they were incredibly well trusted and respected by, and this was just a testament from the clients that we met of theirs and the testimonials that we were able to receive when reaching out to kind of some of their existing customers, that they thought like owner operators, which is quite rare to have from people who are kind of doing agency consultancy, right? You don't actually get that many people that go from brand side to agency side, especially not as founders, right? And I think this was something that was very unique there. But not only that, so not only were they able to advise on so how to grow via digital means and being agnostic in terms of the full funnel planning, they were also advising on how to raise funds, and or in the process of raising their own capital to be able to deploy and invest into primarily D2C, so consumer and tech brands at kind of seed and Series A, because both of them had a lot of hands-on experience here. One was former VC himself. One had obviously gone through kind of a number of raises and exits, Joe. And yeah, they felt that there was a bit of a broken model when it came to early stage brands raising funds. Lots of different reasons for this. Traditional VCs are incredibly aggressive with certain terms, as I'm sure anyone who is listening and has gone through this experience themselves can attest to. It's quite a tough environment, because naturally they're volume investors. They want to see kind of high returns. They bet big, but they bet wide and broad, and therefore terms are very aggressive is a word to use, but yeah, it's very preferential, let's say, to the investor. And I think that's an area that Jake and Joe were advising brands on how to navigate that, because it's tricky. But then also in tandem to that, kind of when looking to invest their own capital or their own kind of raised capital, trying to operate more like a family office in the way that they weren't volume. They weren't looking at doing, dozens of investments per annum, much more patient with the capital, and also much more generous or collaborative with the way that the terms were drawn out, because I think both of them had close peers and friends and relationships with founders who had built an incredible business early stage, had gone through that quite exhilarating but also terrifying kind of process of needing to raise funds and having to raise in order to kind of continue their journey, and then had been ultimately stung via overinflated valuations attached to those businesses, that then when market conditions change or something else happens, the preferential terms that the VCs had mean that they can take all the capital out first, and are ultimately left with being a founder of a business that isn't worth very much or is worth nothing in many cases, which isn't a positive experience for anyone really. It doesn't work for the VC, it doesn't work for the founder, it doesn't work for the market or customer, and all of these businesses end up kind of going under due to kind of quite a lot of this Shark Tank like environment. So we wanted to, they were wanting to do that, but they didn't have the capital. MNC kind of came to the table with a balance sheet, with a shared vision of the industry and a shared understanding and relationship with the type of profile of customer that they were speaking to and working with, and it felt like a meeting of minds, to be honest. So we were able to make that acquisition in around the Christmas period, just either side of Christmas. The heads of terms and the final MSA were signed, and we were able to announce via conversations like this in February, and it's been fantastic. Actually, it's been a really exhilarating way to change our proposition outward facing. Obviously, we can now go to market as not just a media agency, but a media agency that also has a number of different other capabilities, a ventures business, as well as an agency matchmaking service, MNC Club, that is part of our go-to-market.
So what has changed then in terms of, it's been a couple months now.
Yeah.
Are you looking at client acquisition differently because you have all these different other things you're taking to market? Or what kind of challenges have even cropped up about merging the two businesses together?
Yeah, so merging the two businesses was relatively seamless. Like I said, we aren't a large organization. We're an indie, they're an indie. So actually the coming together of two businesses like that means that we wanted to spend as little time as possible inwardly focused, right? So operationally, like there was a few normal things you'd expect from any companies coming together of migration of operating systems and stuff like that, but it's certainly not.
How big is MNC versus Grwth when you
So
bought
billings wise, we are probably 10x the size of them, but headcount wise, we are about 3x the size. So, and again, together we're less than 25 people.
And what's
So,
that in real term? Yeah, 25 people total.
Yes, yeah.
Right.
Yeah. So like the bringing together kind of the two outfits where it's not an IAPG and Omnicom kind of.
We'll get onto that later.
Yeah. It's and for good and bad, I'm sure there's efficiencies that are happening there that are beneficial to their P&L. But for us, it wasn't about efficiency at all. It was about, again, the term 1 + 1 = 3 is used a lot in the M&A world, but this certainly felt like that. They had incredible advisory and consultancy services, but weren't able to execute end to end on media plans, and in many ways weren't able, even though they're advising some really high profile, really exciting, high growth brands that many people will recognize as some of the UK's most exciting startups, weren't always in control of the outcome of the advice and the consultancy that they were giving. Whereas having your hands on the money, as media agencies are, is a much more obvious way to demonstrate that value and to be able to dictate the terms of the relationship with the client in a different way to pure kind of consultative fees, if you like. But equally, like they had a flag planted right in the middle of this really strong community of founders who are all very well connected to each other, are some of the most disruptive entrepreneurs in the UK at the moment. So and that was a scene that MNC had drifted away from over the past kind of 5 years or so. So we were able to parachute ourselves back in there. So it was very complementary in that sense, and that's been reflected in a number of different things. So we, again, you'd be kind of ignorant to kind of ignore the point that a big part of this was for deal flow and for kind of bringing kind of new customer conversations into the fold. So we are now able to be far more credible, I think, in the conversations that we would have been having prior to that, when we were a pure play media service agency. I think we are introduced much further upstream in conversations, because when you've got a balance sheet that is there to be able to deploy it against investment and venture, as well as a company that is incredibly capable at spending that's kind of investment and that capital, it means that you are not only earlier in the conversation when they are deliberating, how they might be raising funds and why they might be raising funds and how to deploy said funds, proceeds of funds, but also really kind of going a level deeper on their business model. So understanding everything from their supply chain logistics all the way through to how they work with their product market fit and lots of.
Yeah, when you're going to clients, is it we're coming at you as actually want to invest in your business, or is it we're coming to you because we think we could really help with your media planning?
It's a mix, and I think quite intentionally it's a mix. There's probably like a golden egg kind of brand for us, and hopefully we'd like to think that this is reciprocated for us being the perfect fit kind of investor or media proposition agency, if you like, whereby they benefit from both the investment and the capital that we can deploy into their business, as well as the services that we are able to offer to help them grow that business. Because at that stage, we have skin in the game, right? Our goals are completely aligned, much more so than a traditional kind of agency client business would be, whereby, you can align KPIs as much as you want to client goals, and even, brands and agencies that are more forward thinking when it comes to aligning services to whether it's client profitability or market cap or what the clients really care about, rather than just fees per hour or rate cards, which I think I've spoken before about. I think will be a thing of the past in the coming years, I hope. So it allows us to engage in those conversations with much more gusto. But that being said, there will be brands that we work with that are either slightly too late stage for us to invest in, right? We are investing in seed and Series A. So there are clients that we've got on our books now and we'll continue to kind of speak with and want to work with, who are further down the line than that, who are, raising Series D capital. It was a bit rich for our blood. But I think even in those conversations, the fact that we know and understand the pressures of raising capital and how to spend it, and what CFOs want to see as a return of said capital, or how to navigate cash flow from the inside of a business as well, is just something that, from my experience and my exposure, many agencies aren't even in that conversation at all. And I think it does bring that string to the boat. And equally, there'll be conversations where we will invest in brands that are maybe too early or too young in their development for us to kind of partner with, because either we are, they're not looking to deploy media capital at the
beyond Meta and Google,
exactly,
or whatever.
Yeah. And in that case, it's probably better for them to do it in-house, right? It's much more efficient for them. And we'll say, we're there when you're ready. You don't have to work with us, right? If you think there's another partner out there that's a better fit, we might be on the board. Who knows? We might be able to help make that decision with them. But it's certainly been from the early kind of go-to-market. It's felt like it's a virtuous circle. It's felt very collaborative, and the feedback from the brands and the companies that we've been working with. So we get introduced, obviously, to some to say, we're doing a round. Like, do you want to get involved in this? These are the terms. This is the investment memo, etc. And then there's other ones where it might be from the other angle, where it might be more around, we're looking for a media partner to kind of help us raise these, and we speak to both, right? We talk about the market intelligence that we have. We have a front row seat to almost all of the UK's most exciting high growth businesses, what they're spending their media on, how their kind of customer acquisition is going, what their CPAs look like. Again, lots of this is sensitive to we don't overshare it with other brands, but it does mean that we have an ecosystem internally that gives us an unfair advantage, if you like, we feel, compared to many other agencies that don't have this proposition.
Sure. In terms of as a model, you mentioned that you didn't want to just be on par with some of your competitor indies. You didn't want to just have a full funnel media proposition, but to do something different. Do you think this is a model that other agencies could or should be looking at? And I mean, if so, what's been taking them so long? Like, why were you sort of the first ones to consider, actually, why don't we invest in the business that we're doing media for?
So we're not completely alone in this space. There are one or two that have tried and tested and played around with it, whether it's for PR purposes or whether it's for deal flow purposes or whether it's for actual kind of business, kind of pure play, kind of, I want a return on this. We chase returns, not retainers now, if you like, on all the activity that we have. But there are one or two out there that have similar capabilities as part of their offerings, but they kind of take part in different forms. So for the most part, other agencies that you'll see with a form of venture investment will be more around creative for equity, media for equity, rather than pure play capital. Now, we were very intentional that we didn't want to get involved in the media for equity, creative for equity play, just because first and foremost, Joe and also a number of his peers at various different high growth brands had some unpleasant experiences, let's say, with media for equity. I won't go naming exactly who those arrangements and those terms were with, but I suppose just kind of a quick overview. If you're an early stage business and you are looking to raise capital, often it's to spend or deploy on either creative, so like revamping your brand, making it more fit for kind of the next stage of your growth, right, or media, right, to be able to deploy that against growth and attracting new customers. So being able to, when you're cash shy, being able to trade that with an agency, so being able to say, we'll give you an amount of shares in exchange for some creative, so to be able to rebrand us or to be able to deploy on certain media channels as an investment, sounds good on paper. However, the experiences that we've been exposed to are where you'll have someone's raised 250 grand worth of creative for equity capital against a certain percentage of their business, depending on the valuation. They will then rack up a bill attached to a rate card, right, that kind of says, we have now done 200 grand's worth of work for you. You've got 50 grand left, and they're like, well, no, we're fucking near the end of like where we need to be.
You need to spend a lot more than that.
We need to spend a lot more than that, right? Yeah. And then you kind of quite quickly try and rush it over the next 50k worth of creative kind of rate card spend, and all of a sudden you're like, okay, our go-to-market isn't here, and then they'll start sending you bills, and you're like, and the brand are like, well, we can't afford you as an agency. Like your guys' rates are probably double or triple the size of what we should be taking on as an early stage, potentially like less than 10 million annual recurring revenue company. And then it's quite a sticky fallout when you then have to engage a smaller agency to then hand over all of the kind of the larger creative for equity player. They're still kind of, potentially on your board, or they've got some sort of involvement. So it becomes quite challenging. We always wanted to be much kind of cleaner with ours. And I think, Jack, the reason that we might have been able to make a play in this more so than others is quite simply because we have the capital to deploy. Like, not many independent agencies are as lucky, maybe I would call it lucky actually, are as fortunate as we are, that we've kind of been able to have a very strong balance sheet that we've protected over time and have been very intentional with how and where we've deployed that. And now we've made a very kind of strategic and clear decision that, it's not entirely going to be deployed for investment into high growth challenger brands at Seed and Series A. There will be investments that we'll make into our own core proposition and to future acquisitions to integrate into the group.
What if the money runs out? What if the investments don't pan out and you're left with a blind spot?
Yeah, I think that's where we just need to be very strategic and diverse with the investments across both our core proposition and that business. There's a couple of ways to navigate that. One, we're not making those big, wide VC style investments where we're trying to make 10, 12, 15, 20 investments a year. Like, that is a very quick way to
one or two
dry up your cash, right?
Yeah.
We're not looking for kind of overnight success stories either. So, generally speaking, it will be kind of 5 to 7 year returns for the most part on the capital that we deploy, but we're not sinking the entire balance sheet into this. And these are longer term plays that allow us to advise brands and be in different conversations with brands in much kind of earlier cash generating conversations than we would have been able to otherwise, whilst also being able to benefit those brands from the capital that we can deploy. So we will still continue to generate cash from our core services, if you like, whilst also giving ourselves another area of the business that will future-proof us and allow us to, again, turn up in conversations that we wouldn't have been able to do otherwise.
So I want to move us along a little bit to discuss. I know you have a lot of opinions about the broader agency landscape, and it sounds like you're sort of trying to carve out a very unique space and one that maybe isn't well tread yet. At the moment, and since we last spoke in February, a lot has happened in the world of media agencies. We mentioned earlier IPG and Omnicom. They're progressing toward their merger, expecting to do that sometime later this year. WPP, your former employer, is in a era of transformation, as they're calling it. They recently announced Group M. Agency brands are essentially getting sort of sidelined. Agency job titles are being quote unquote sunset. I think that's a very kind term. Agency brands will be retained as quote unquote client service brands. That's per our own reporting at TML. I'm curious what you make of the current agency landscape as someone looking at it from the perspective of an indie who has worked for the big holding groups before.
Again, first and foremost, I think it's important to say that we're not anti holdco. I've worked in a holdco before. I've kind of said at the start of this conversation, I've got a lot of respect and time for the people there and what they've built over the years and the relationships that they've been able to forge with kind of big high profile brands that operate multi-market and multi-channel and multi-discipline and everything else. So, and there's good people in those companies, there's talented people in those companies, and there's reasons that brands have gravitated towards them, right? And I think they will always have a place for a certain profile of brand, right? If you're a CMO or a CFO or a CEO of a large corporate organization that needs to deliver efficient multi-market media planning, buying, and potentially creative as well at scale, then lots of the holdcos, whether it's Publicis or WPP or Dentsu or the IPG Omnicom, whatever that ends up being called, there's a place for those in there, right? There's an argument from the indies that they're 5 different shades of vanilla, but they are ultimately able to offer something that many indies can't, right? Which is, it's a bit of a pilot high, sell it cheap initiative, where they've got, billions and billions in billings that they manage and handle, almost like a bank, and assets under management, and they make a lot of money off the interest attached to that money that they handle, and various other principal media incentives, let's say.
I'm sensing you dislike the idea of principal media trading.
I'm not against the idea of principal media at all. I think in many ways, it's been an important way for agency businesses to attribute a true value to the service that they offer, actually. I think the way that it's generally handled and spoken to in quite shady, behind closed doors, kind of, this is kind of, for us to know and, not for you to kind of, keep a blind eye to, Mr. Client or Mrs. Clients. I don't think that's great, but I think generally speaking, and I've spoken about this before, I think the media marketing advertising industry as a sector has always done a really terrible job at valuing its services. We're the only type of service-based company that makes brands money. You look at the legal system or legal service-based organizations, or accountants or management consultants. These are all service-based professional services organizations, all save clients money. They will come in and tell you to cut money here, or to invest in certain legal plans here in order to protect the business and make sure that you don't lose it. But ultimately, they don't make brands money, right? Media marketing, advertising make brands money, and yet don't necessarily the bottom of the food chain ultimately in terms of the rate cards that we've been able to charge over the years. So I think that principal media as a whole has been a good way of ensuring that media agencies and advertising agencies are better remunerated for the value that they can offer. The challenge comes with when it's, like I said, either shady or backhanded or seen as, smoke and mirrors, or when it's ultimately not attributed to good value work or good work. And that's where there's a little bit of a dissonance between the indies and the large kind of more corporate PLC organizations, which is where they are incredibly incentivized to invest into certain channels in order to meet trading deals, and incentivized to meet certain quotas of investment into certain places in order to make their own balance sheet work and in order to meet their own shareholder interest rather than the brand. So that's where it comes unstuck. I don't dislike the idea of incentivization for doing good work if it's measured against the right things.
Mm-hmm. What do you think the opportunity is for indies in an era in which holding companies are consolidating, either externally by the acquisition of IPG by Omnicom, or Group M is obviously consolidating its own agency brands?
Yeah.
Is there an opportunity that presents for indies or other types of competitors?
I think so. Yeah, there's been a changing of the narrative, I think, for a year or two now, where a combination of different factors playing into this. But I do think that brand side marketers, I think they're challenging their own thinking and of the Kool-Aid that they might have been drinking, or their predecessor might have been drinking, attached to a network and what that offers, and the gravitas and the shiny offices and things that you might be able to get, the ivory towers that you can walk into a boardroom of.
They're nice buildings.
Nice buildings, yeah, nice buildings. Lovely croissants that you'll get at your next quarterly business review. But I think they are certainly starting to question the value of their return of their investment more so, and I also think that it's for if you put yourself in the shoes of a, let's call it like a mid-sized organization, so not the ones that I mentioned before, like your Fortune 100 companies that need to operate in 30 different markets, and actually whether you call it the pilot high, sell it cheap model or the efficient kind of media buying model will probably work for many of those. But if you're a mid-sized brand that might be operating in less than 10, certainly less than 5 markets, and you want and you value service, attention to detail, and probably quality talent who are incentivized better to kind of work for your brand, for their indie business, rather than being a bit lost as a cog in a wheel that you might find a lot of the staff who are in the network organizations are. I think there's something incredibly attractive about an indie outfit to be able to offer and kind of show the value that you just won't be able to find in a network these days. So I think there's loads of opportunities for indies for that profile of brand. And like I said, if we do speak with lots of client side marketers like this, and I think they are, even if they're not actively seeking, they're certainly actively listening to the sounds and the conversations that are coming out of indies. It probably reinforces some of their own doubts that they might have in their mind as to whether they are getting the right value from some of the networks. And I think, when you see things like the Group M sunsetting of brands, which is it's not a huge surprise, let's say, when the amount of pitches that go on are at WPP level these days or network level. When you see the IPG and Omnicom merger, and they'll dress it up as, a way to kind of deliver better service for less money, and they'll spin it with their new AI model that they're rolling out. At the end of the day, it's accelerating a bit of a race to the bottom, I think, where you're commoditizing a service that is supposed to be, to my former point about bringing value to the brands and helping them grow their businesses. And actually, it's just going to become a case of, well, you all look and feel roughly the same. You're all going to have a very similar AI-led bidding or programmatic model in order to kind of be able to deliver the services that I want. There's only going to be very few people in those businesses that are doing certain services that were happening a few years ago. So who's cheaper? And I think if we allow that to happen, I think it's going to be a sad state of affairs for the industry, where we continue to push this narrative that cheaper is better.
But that's what brands want. I mean, brands just do want more for less. I mean, and that's been going on for many, many years. They
always will, right? They'll always try and find.
And if AI can deliver that efficiency, then why not?
And I think good. I think, I'm a fan of in-housing where in-housing makes sense. I'm a fan of utilizing artificial intelligence where it makes sense for certain automation. Where it doesn't is where it's trying to replace the high-level strategic thinking, creative and innovative thinking that agencies have always built themselves on. And that, especially at kind of a senior end of the business, where you've got consultants who can advise brands on how to invest and grow for the future in a way that they just can't interrogate themselves on internally in the way that they need to. And I think there will always be a value for agencies and consultants and lawyers and other kind of professional services for that. Whether AI is coming for all or none of their jobs, there will always be a role for it. I'm of a view that the commoditization of the service is not a good thing for the industry. And I think indies have a role to play in changing that narrative, talking much more about value rather than cost, and talking much more about and aligning ourselves to said value, and trying to do a job of ensuring that remuneration models or compensation models, whatever you want to call them, that are built between brands and agencies are much more reflective of the outcome or the outputs, right, rather than the inputs. And I think there's and that's why I think what MNC are able to do is great, because not only are we an indie, we also work with a particular profile of brand that are much less procurement led, right? They are much less, they don't have the handcuffs tied by certain legal constraints that says you have to go through said red tape and said bureaucracy in order to make a significant change. We are generally speaking dealing with, either founders or sometimes CEOs, CMOs who are incredibly incentivized, incredibly attached to that business, quite often shareholders within said business, if not early stage founders themselves, and are able to, look a smart agency leader in the eye and say, yeah, you know what, if you back yourself to be able to, increase my CM3 by this, or my kind of bottom line profitability by X, if you are investing this amount of money into it, then yeah, you can take a share of that spoils. Or equally, if it's a blended, CPA that you're looking at across both an upper funnel and a lower funnel investment, and you say, look, I think we can seriously make an impact on this. And if we are investing a certain amount of money into this and we are seeing our bottom line, let's say, increase by that much, then yeah, the agency that are responsible for advising on that and deploying that and helping navigate us through that in a way that we wouldn't be able to do internally should be incentivized against the targets or the maybe the profits attached to that. So and that conversation just doesn't happen at the holdco level, and it doesn't generally happen at the procurement-led brand level either. So like I said, there's always going to be a place for the holdcos. I don't think they're going away anywhere overnight. It's not the rise of the indies that are going to take over, far from it. But I think there'll be a correction in the market where indies have more of a seat at the table for good reason. And I think that the smart brands and the smart clients will start to give indies much more of a shot, particularly those ones that don't feel that they need to have everything that only the holdcos can bring. So the
big scale,
or the internationalization or whatever.
Large markets. Yeah. What about talent?
Yeah. I mean, I think there's been an exodus there's been a voluntary and involuntary, unfortunately, exodus from a lot of the networks in the last few years, but it'll have been seen very sharply in the last few months, right? It was, well ahead of the WPP announcement, a lot of the really talented, really smart individuals who had kind of been there and, offered incredible services, I'm sure, to those companies and their clients have been moved on via efficiencies or redundancy processes. You only need to take a look at the IPG and Omnicom announcements, and you don't even need to read between the lines that much to see how much of that is to do with shedding of talent. And, when I said 1 + 1 = 3 earlier, I think I saw a quote that is 1 + 1 = 1.75, right? I don't think it hasn't made an incredible impact on the share price so far. I can't see a way in which that business model is going to be any better than it was before. It's just more bloated, I would say. And
I'm sure they would argue more scale. They can offer more to more clients.
I mean, what more scale do they need, right? Like in the current world and market, like being able to offer, another market or another territory or whatever, or even just another level of billings attached to their own balance sheet. I don't see how. I can't believe many clients are buying that as a sell, personally.
But there's concern around job loss, redundancy, particularly if people aren't client facing. It sounds like what you're hinting at.
And I think we're going to continue to see it. I think the word efficiency has been used quite a lot in varying parts of their press releases, and that's a very, very thinly veiled way of saying we're going to be letting go of everyone who isn't billable in some way, shape, or starting to kind of and even those people that are billable, there's going to be ways in which they can make their roles more lean and more efficient. So I think there's going to be, unfortunately, all of those companies are going to be shrinking in headcount in order to kind of try and retain their profitability.
Does that not offer an opportunity for yourself to hire more people? Are you looking to grow?
Yeah, we've been
headcount?
growing. There's a combination of factors that I think have allowed us to grow better. For starters, I mentioned that we're an EOT, which I think is a really positive trait to our company. That not many agencies actually have set themselves up with this model, but it does mean that we have a profit share model that goes out to all employees, whereby at the end of every financial calendar year, we distribute profits out to all employees who have been with the business during that period. So that's something that I think is incredibly attractive, that many companies aren't able to offer in the same way and at the same scale that we can, with all the different benefits that come with it. But also I think something that's been quite interesting for us, the diversification of the business and launching the ventures arm has brought not only a different conversation that we can have with brands and with clients and customers, but with talent as well, with people that we want to attract. You get a lot of marketers who have reached, I guess, the top of their game, who are kind of, A players, if you like, who have either been brand side or agency side, but I've never really got into the real commercial conversations that you can have when you're talking about deployment of capital and investment of capital and the implications of that to a business. And I think that's definitely, with the interviews that we've been conducting recently, and we've been growing and bringing on a few, not a ton, but a few kind of select new members to the team as we've been going through our pivot and our new kind of growth journey. But that's been a really exciting part of the conversation where they've said, I love the idea of not only being able to understand our brands and our clients from a marketing point of view, but also from an investment point of view, why they are raising capital, what terms in which they're raising capital, how that impacts everything from, their distribution all the way through to other areas that they might invest in a business and consider alongside marketing, right?
All the same reasons why you wanted to leave a holding group in the first place and learn more about the business.
So if I look at if I'm kind of put myself back in my own shoes from 5-6 years ago, I think the proposition that we've got and that other indies are able to offer remains incredibly attractive, if not more attractive than it was 5 years ago, for this reason and for others, because you're able to dictate your own terms in ways that you weren't able to do before. You're going to get much closer, I feel, with brands than we've ever been able to. And I think the relationship between brands and agencies becoming more consultative, more strategic, as things like AI and in-housing trends take place, and a lot of the more administrative manual tasks are either, taken on by clients themselves or are handed off to various tools and software that allow us to do those things more efficiently. I think that's where the indies will really be able to step up and attract the talent and be able to maximize that as a service, because we can move faster than the holdcos. That's a simple fact, and I think the smart clients will recognize that and will engage and will continue to invest when they see it working.
So, final question. It'll be your 1 year anniversary, I believe, sort of just a few weeks after this podcast comes out. Yeah. What's year 2 going to look like for you personally and the wider business at MNC?
Well, yes. So in the summer will be kind of 1 year anniversary. I think 2025 has been very much about proving the model and taking it to market. And I think we've seen a really excellent response from both existing clients, where we've been able to take either existing different types of services to our existing clients and be able to kind of demonstrate the value of having, full funnel agnostic media planning services, as well as the benefits of having the ventures arm and MNC club within the group that have benefited. So I think continuing to see traction there is going to be a really important part of the future business. We've seen our deal flow and pipeline triple kind of since Q1. So that's being able to, I think, kind of close a number of those is inevitably an important signal that brands are interested in this, more than interested actually, are kind of wanting to get out, their own checkbook at times and signal that they want to give this a go, because I won't speak to the brand names, but we are in late stages of a number of different pitch processes with brands who are leaving either holdcos or very, very large independents that act in very similar ways to holdcos, just based on their size and scale and structure.
I can't imagine who you might be.
Again, I'm not here to kind of throw names under the bus, but yeah. So that's kind of number one. Let's kind of prove the model, and that's not overnight, but it's certainly kind of we're seeing more than green shoots. And then if I look kind of further forward to 2026 and the early stages of 2026. We've mentioned that we want to become the home of challenger brands. That's kind of a tagline and mission statement. And to become the home of, we need to feel like we are the one-stop shop, to kind of use quite a crude term. And as it stands, we are not said one-stop shop. We have a number of different services that we don't have in-house yet. So it's
commerce or retail.
Yes, retail marketing is an area that we currently don't have under our roof. We have some very select partners that we work with brands on when it comes to offering retail marketing, whether that be via Amazon services or even in-store retail services, which is becoming, particularly for lots of FMCG brands, is a very, very important area for their growth as they start to look to build retail relationships and get their products in on shelves. That's an area that we are going to look at with keen interest towards the back end of this year. So there's a good chance, I won't make any promises, that we'll be going back to the M&A planning board and trying to understand who might be the players in the space to bring into the MNC fold there. And who knows? I think, my background is social and influencer, and that still plays a very, very important role in the market, particularly, well, for brands across the board, right? Whether it's your Unilever, who have kind of declared in the last few months that they are going to invest, I can't remember what it was,
About
but
half.
Half of their budget towards social and influencer, which is a significant shift from where they were before. So anyone through from those kind of really, really large multinational corporates all the way through to high growth challengers, it's an important area. And there's only so much that we are able to offer without having a dedicated outfit and strategic minds dedicated to that. So there is a chance that we will turn our eyes to that. However, my kind of personal view is that influencer as a channel is probably overpriced at this moment in time and is still due a bit of a correction. That's both from a media channel as itself, as well as how the agencies in the space value themselves. So we're probably not going to be in the next 6 to 12 months.
That's interesting.
Scoping out an influencer agency to acquire.
Because influencer marketing is set to double within the next couple of years.
Yeah.
So, some would argue that they're underpriced at the moment.
That's not necessarily a reflection, I would say, of the channel itself. I would say that's more a reflection of a bit of late enthusiasm from some of the bigger players. I think you've seen a lot of the smarter brands invest early in this and not draw back. The brands that built their success stories off it. Your Gymsharks are kind of thrown around as now a very well known and respected brand that invested almost entirely in influencer and social and digital in order to build a household name, aren't growing at that same rate. I think a lot of that is coming from the Unilevers of this world that are starting to, at a later stage, invest in it. I expect they will dump a lot of their spend into it and then probably correct as they start to see how it has an impact on the funnel. So I think if you're a smart brand or an agency like us, I think you absolutely need to have influencer as a core part of your media planning proposition. But I would say you need to be much more deliberate about it than I'm seeing take place in the market as it stands. And you get lots of brands that get stung by it because they are not approaching it with the right strategic intent or plan, and rather just saying, if we just shift 20% of our TV spend into influencer, it will deliver the same, and it doesn't, right? So
you're waiting for a potential bubble to pop.
Bubble to pop would be a bit of an exaggeration, I would say, but certainly a correction, I think, is probably what I anticipate seeing, both the influencer space as a channel, but also when it comes to the valuations attached to the agencies in the landscape as well.
Interesting. Okay, so lots more M&A to look forward to potentially.
Hopefully. Yes. All things being well, if we sit here in a year's time, then there's a fair chance we might well have another business sat within the MNC org. But who that is and exactly what sector it is will depend on a number of different market factors, as well as our own traction and growth trajectory.
Gotcha. Well, I'll certainly be keeping an eye out. Luke, it's been a real pleasure. What a great conversation.
Thank you. No, I appreciate it.
Thank you for listening to the Media Leader Podcast. Our executive producer is me, Jack Benjamin. Special thanks to our production partner, Trisonic. You can find all our episodes on the podcast platform of your choice or on our website at uk.themedialeader.com. But do please remember to subscribe to be notified of our next episode. You can also subscribe to our newsletter at The Media Leader to receive daily coverage of all the biggest news stories in media and advertising. From all of us at The Media Leader, I'm Jack Benjamin. See you next time.